Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. The market kicking off a new month with signs of strength. Investors shaking off those concerns about the wild moves of the metals and Bitcoin. They're also focused squarely on big tech results from Amazon and Alphabet later in the week. The economic picture looking a little more uncertain with the government shutdown delaying the January jobs report. We're taking a deeper dive on the consumer and looking at how the shopping patterns that developed during the pandemic are sticking. We're also tracking the earnings action after closed Palantir shares surging after results handily beat estimates. Plus, we'll keep an eye on Simon Property Group. We're taking a closer look at the state of the consumer and how behaviors have changed and stuck thanks to the COVID pandemic. Joining me now, we got David Tinsley, Bank of America Institute Senior Economist. David, it's good to see you. So let's start right there, David, because you've done a lot of research into this, how the pandemic impacted sort of just how and when Americans spend their money. Walk us through the data, David. What did it tell you?
Yeah, what we've been doing is we've been looking at the card data, the credit and debit card data by the hour of day that people are spending. So not just the usual kind of weekly or monthly view. And when we look at that, what we see is pretty interesting. What we see is people are spending more at grocery stores over the lunch hours, and they're spending less at restaurants. And I think, I can think of two reasons really for that. One is obviously the pandemic was working from home, and that has basically stuck to some extent. Still now, around a quarter of full-time working days are spent at home. You know what it's like when you're trying to organize a lunch date now with someone. They're out the office, you're out the office. So it just makes it harder to sit down across the table with someone. So the grocery transaction is kind of replacing that lunch date to some extent. And I guess the second reason, in all honesty, is cost as well. We hear so much about affordability, K-shapes, etc. It's usually cheaper to grab a sandwich from the grocery store. And I suspect that has something to do with it as well.
So morning, afternoon patterns. What about weekday versus weekend, David? What did you find there?
That's pretty sticky. So around 2/3 of transactions are done across the week and about a third at the weekend. So per day, there's more spending on each of the weekend days, but in total more is done at during the week. That hasn't really changed actually over the last 5 years.
So these changes that you're breaking down, David, broadly, would you say, okay, they're temporary, or no? You think what we're seeing here, these trends, these themes, durable, sustainable?
I think they're probably quite durable, to be honest. Like I say, one of the trends that's driving that is working from home. There's no real sign that I know we get media reports occasionally about people demanding people come into the office, but the surveys of whether people work from home or not are relatively sticky right now. So it peaked, I think, about 40-50% of people were working from home in 2021. It's back down around 20 to 30% now. It's not really showing much sign of declining more. Affordability, that affordability pressure, that could come off some, obviously, over the next few years. That will wax and wane. But I think a lot of these trends are enduring.
Let's say, David, maybe I'm listening to this and I own a grocery business, or I'm a retailer. Should I be, David, hearing about this data, and I'm listening to David's research right now, sort of these trends, these themes? Should I be maybe considering changing, David, store hours? Should I be thinking about changing staffing, how I staff my stores?
Well, that's an interesting point, because the other finding we made in this report was that just the kind of quantum of sales has slightly drifted towards the morning and away from the afternoon, and then that lunchtime impact as well. So I'm sure, most shops are already reacting to that. They're already seeing those transactions and that shifting in timing. But I think, I think if you're not doing that, then maybe you want to give some thought to how you position your offering and your store opening hours.
The changes you saw, David, too, was it across sort of all socioeconomic groups? Was it across low, middle, high income?
We didn't break it down by income in that report, but what we have seen in our overall spending data is this K-shape. So we are seeing higher income spending growth, 3% or so, lower income spending growth, below 1% or so. So there is this kind of quite large K in our data gap. So I'm guessing in so far as it impacts time of day, it's going to be the lower income households in particularly who are driven to the grocery store over lunchtime for the reasons of the savings to be made.
It's an interesting point about the K-shaped economy, David, because we talk a lot about it. I feel like it's been a K for a long time. Do we talk about it more, David, because as an economist, you look at the data and the K is getting more severe?
Well, in our data, the K kind of ballooned out over the second half of last year. It got to about 2 percentage points in terms of the relative difference in the growth rates between higher and lower. And actually, it stayed relatively constant for the last sort of 6 months or so at that sort of 2 percentage point difference. So I'm not totally sure it is getting wider. And then just to throw another kind of spanner in the works, the tax refund season that we're about to get, that will complicate matters as well, because everyone's going to get quite a lot more refunds than they did last year. The lower income households are probably more inclined to spend that, and they're under more pressure to do so. So potentially for a time that could kind of buffer the K-shape somewhat. But I think at the end of the day, it's going to come down to the labour market when that tax refund season ends. And in our data, we still see wage growth for higher income households, again, about 2 percentage points higher than lower income households' wage growth. So right now, the odds are stacked, I think, in the K sticking around this year for most of this year once tax refund season is out of the way.
Final question, Dave. I'm just curious. Were there generational sort of distinctions and differences in the data that were worth pointing out? Did younger and older consumers, were there differences notably in how they were spending, where they were spending?
Well, what we've seen for some time in our data is the older households spending growth outstripping the younger spending households. Now, what we've interestingly seen in our data for probably about 6 months or so now is Gen X is the weakest spending generation. So that generation is under the pressure. So they're probably also the guys heading to the sandwich and the packet of chips from the grocery store rather than the meal out.
David, as always, great to have you on the show. Thank you.
Thank you.
Stick around. We bring you our biggest takeaways from the first trading day of February. That's next on Asking for a Trend. Stocks starting February on a high note with investors digesting earnings and moves in precious metals. For more on the trading day takeaways, let's get to Yahoo Finance's Jared Blikre. Jared.
Thank you. We got to talk about some records. Might as well start with the transports. And it all started this morning off of that hotter than expected ISM report. And so that speaks as to the strength of the manufacturing part of the economy. And it's only one reading, so it doesn't necessarily make a trend. But I'll just show you one stock in particular. And by the way, these are all the Dow Jones Transportation Index components. And there you can see that nice jolt after 10 a.m. So really unexpected there. FedEx up to a record high. Then you see Delta, Southwest, and United up 4-5% here. And then names that we don't talk about every day, like really into the logistics of the transportation sector. JB Hunt, Ryder, Landstar, those up 4-6%, and the list goes on. And I thought I'd show you too, do a little bit of Dow theory. And so that's when we compare the Dow Industrials, and that's in purple down here, to the Dow Transports. And the transports are really surging. They're up almost 9% this year. You don't always see that. Usually the transports are lagging a bit, at least they have over the last few years for the most part, but they have really surged ahead. And you want the Dow Industrials and the transports to confirm each other, and the strength is confirming strength. Dow Industrials, it looks like they're down like all the way down here, but they were almost at a record. So this for me is confirmation. Also mentioned industrials, xAI, large cap industrials closed at a record, and so did Staples, and that was a Walmart story. New CEO is taking the helm there.
Now, market historian that you are, what does history suggest, my friend, about February and the rest of the year?
Well, we just closed January, and according to statistics from Ryan Dietrich, when you close January green, you have about a 90% chance of closing the entire year green. So things are looking good from that perspective. And let's take a look at some of the seasonal tailwinds right now. This is my own personal market map. This goes back, this takes S&P 500 data going all the way back to 1928, but it only includes the years in which we have the same day of the week. So for instance, you'd need to see February 2nd land on a Monday. And going back to almost 100 years, we only find about 13 of those years. And so you put it all together and you get this map right here. And I found this map to be particularly useful over the last few years. I also have year to date in green. It's a little hard to see, but I think we were up, 1.3, 1.4% in January, and the model said something like a little bit higher than that. So we're right on track. As you can see, we rise with a few zigs and zags into April, then we decline into May, then we rise into July, early August, decline into October, and then into the beginning of December, then kind of flatline. No real Santa Claus rally according to this model. And we don't have to follow this, but you can see if you're looking at the percentages there, 15%, fourth year of the bull market, that would not be too bad.
Now, I want to end here
Yes.
on Bitcoin.
Oh.
Because, Jared, when you're right, you're right. And you have said on this very show, the line in the sand, the Jared Blikre line in the sand, you said it, time and again, you said it, 75,000.
Yeah, what did we hit?
Okay,
Yes.
now what? Now what?
All right, so let's Bitcoin destiny here. Let's take a look at a chart. Why was I saying 75,000? It was just, the charts were just screaming this level. So let's pull this up. Take me a second and we'll see our crypto heat map. Not looking as good as the transports today over the last, that's not it. There we go, crypto. We do see a lot of green here. This is over the last 24 hours. If you measured since Friday, not gonna look so great. But here is a 3-year view. And so 75,000 was basically 2025 low and the 2024 high. And so that's why I thought we're gonna tag that. We might be off to the races, so looking good pretty soon. I'd like to see us climb over 80 and kind of hold that. But if we start getting below 75,000, the flip side of that trade, and we start using 75,000 as resistance like this, and we start going down, that is my crypto winter scenario. So line in the sand has been respected for now. Low is 74,500. That's good enough. We could even go down and test it again, but I need to see a quick rise back above 75, 80,000.
All right, thank you, buddy.
You bet.
Thank you. Stick around. We bring you a roundup of today's earnings. That's coming up next. SpaceX planning to combine with xAI ahead of its mega IPO later this year. Bloomberg reporting. Praz from Radiant has the latest. Praz, fill us in.
Yeah, so this, we've been hearing about this earlier today. We heard the similar report, but now it's supposedly Bloomberg is confirming it, that SpaceX will merge with xAI in a deal that consolidates two of Musk's biggest private startups, right? So the deal was announced reportedly in a memo per Bloomberg sources, people who did not ask to be identified. The two companies, sort of appear, Josh, sort of as an odd tie-up, right? So Musk has spoken about using xAI sort of AI models in SpaceX business pursuits like rocket development and Starlink satellite development, and future projects as well, such as data centers may include xAI software that could be a thing. So, SpaceX was initially going to have an IPO that could raise as much as $50 billion at $1.5 trillion valuation. The question is, how does this change that if you have xAI as also a part of that company?
So, Praz, why does Musk want to consolidate these companies? What's Elon's strategy?
Based on the on the face of it, hey, they could jointly use their technologies both to help each other out from a technological point of view, but also you could also see this, Josh, as a potentially, if xAI is a company that's losing a lot of money, burning a lot of cash month to month, maybe it makes sense for them to bring them onto SpaceX. So that's a very big IPO company. People are very excited about making money in the satellite business, right? So maybe it's a way to help out xAI because you're kind of hiding some of those losses, right? That might be part of it, but also on the face of it, it's more about do you share technology? Are the two companies worth more together?
According to the report, Praz, xAI burning around $1 billion a month. Could that be is that a drag potentially on SpaceX's business long-term, Praz?
I have to imagine, unless they don't turn around, we've been seeing that, Grok has sort of been falling down the rankings behind ChatGPT and Google Gemini, right? And that could be a problem, as the company is still, using a lot of servers, using a lot of data centers, spending tons of money on development. I think that even if you raise $50 billion in an IPO, that's a nice amount, but you don't want to be having this drag of, you mentioned $1 billion a month. That's serious money.
Praz, thank you, sir. Appreciate it.
Thank you.
Now time for the earnings roundup brought to you by EY. Yahoo Finance's Brooke DePalma joins me here for a look at Tyson Foods. We're going to start with Tyson, the company top in first quarter earnings and revenue estimates, but seeing a challenging backdrop for its beef segment. So that one, the beef segment extends a string of quarterly losses, it sounds like. Chicken sees year-over-year growth. Does sound like, Brooke, they did maintain their outlook for the year.
Yeah, and what I spoke to CEO Donnie King this morning in an exclusive chat with Yahoo Finance. He did mention that what we're currently seeing within the beef segment is ongoing from 2025, and he expects a tight cattle supply moving into 2026 and into 2027. So the company is sort of rejiggering its expectations here. On the call, he did say that beef was down in the quarter by about 133 million pounds quarter over quarter, but net for Tyson, they were down about 22 million pounds, and that was largely offset by, as you said, strength within poultry, within chicken, their prepared foods, international foods, as well as their pork business. And so certainly trying to offset the declines, the major volume declines that they've seen in beef, simply because there hasn't been enough supply, and also because it's cost more for consumers. And so they're pulling back. And we know that Tyson Foods closed one of their beef product production plants back in the late last year. They also pulled back a bit at another plant, lowering production at one of their plants within Texas. And they said that those will be reflected in the second quarter. But really, it's all about sort of right-sizing their portfolios here as beef prices are higher and consumers are really depending on chicken, which tends to be lower cost here.
All right, switching gears. Next up, the House of Mouse. Disney reporting earnings above forecast, but guidance not dazzling Wall Street. You can see there, yikes, we take a dive by about 7%. So they offer, Brooke, what's being described as kind of a tepid forecast for growth in the current period. It sounds like, okay, maybe it could be tougher to attract international tourists to domestic parks. I saw increased costs for sports rights were also highlighted.
Certainly. And also, to keep in mind, for 2026, it expects operating income to grow by only double digits year over year for its entertainment business, low single digits for sports, and high single digits for its experiences business. That's the parks, things of that nature. But on top of that, too, profits just in this quarter alone fell year over year. And on top of that, Josh, I think that investors right now are really waiting on who is going to be the next CEO. They're gently waiting for the official confirmation, as many, including Bloomberg, have speculated that their current experiences and park business CEO, Josh D'Amaro, will be named the next CEO, but we're still waiting for official confirmation and what exactly that could mean. And CEO Bob Iger did say on the call that I listened to this morning that people asked on the call, these analysts said, what are ways that they could jumpstart, or what are ways that they can get ahead of the business? And he said specifically there has been a lot of fixing since he rejoined the helm back in 2022, but he said that the successor could jumpstart when it comes to the potential to grow their experiences business in particular, which is Josh's background.
There it is. All right. Lastly, NXP Semiconductors is just out with its fourth quarter results. Wall Street not too excited about it, Brooke. We're down about 5% here.
Josh, I think what we're seeing here is really this high bar that the AI trade has demanded within this sort of environment. Keep in mind, NXP is behind their automotive, industrial, and consumer segments. And what we saw during this quarter was automotive revenue miss ever so slightly. And on top of that, too, investors were worried about the guidance that the company had put out. And so it just goes to show the bar is high when it comes to this AI trade.
Chips, chicken, Disney, we did it all. All right. That's a wrap on today's Asking for a Trend.